Welcome to the ARMR Report, guys. Thanks for being here with me. As always, this is a show about fundamental investing. It's the combination of quantitative execution and a fundamental foundation of information flow, and that's what I share with you. Today is part of my ARMR Education series. And what we're going to talk about is round 3 about stop losses. So we've already done 2 videos about stop losses. I strongly suggest you watch those videos. It might answer some of the questions that I might skip ahead and talk about today. And then I'm going to discuss with you guys what I've been promising, which is the first look at a couple of my favorite triggers that get me to buy stocks. So on the one hand, we're going to kind of go over stop losses again, answer some more questions that I've been getting from subscribers and of both the ARMR Report, which you can get at the ARMRReport.com. Become a subscriber. I'm going to answer some questions from there and some questions from YouTube, from you guys. So you're all here today. Let's all work together as a community. If you have questions as I'm going, just ask me. Fill out, just put something into that message board, and I'll try to get to those questions. Real quick, as usual. ARMR stands for Algorithmic Risk Management Research. So I try to focus on managing risk here. And that's why I'm talking so much about stop losses. But also the trigger, the buy trigger that goes with the stop loss. If you're buying wrong, the stop loss won't help you. So we're going to talk about that. I share with you information that I use every day in my own life, investing for myself and for clients I run money for. These are hard-fought rules. I've been doing it over 30 years. I have a lot of bruises, a lot of scratches up and down my back, right? So I'm trying to put you guys on my shoulder so you can reach higher and learn from a lot of my mistakes. And that's how I develop these stop-loss rules and these trigger points of why I put money to work, what gets me to take a step in. All right. I'm not telling you what to do as usual. I don't know you. I couldn't tell you what stocks to buy and what not. But we're going to talk about a bunch of stocks today because I'm going to show you, looking at the charts step by step, what the stops are and what the triggers were. Okay? So you can get a visual representation of what I'm trying to say. So without any further ado, let's get started. Excuse me. Okay. There's 2 types of stops. This is something I've been running into, having more than one conversation in the last couple of weeks, I guess since my last video about stops. So let's go over it. When I say stop loss, on my previous 2 videos, what I was talking about is a principal protection stop. When you buy the stock, how much are you willing to lose before you're out? The reason this is so important is that you have to do everything in your power to reduce the fear and the greed in your trading habits. You have to exercise those demons. Fear and greed will only lose you money, make you frustrated, make you quit, make you walk away. Whether you're a day trader or a swing trader or you're investing for the long term, you've got to do things in your portfolio to get rid of the fear. So stop losses are step 1. If you know what you're going to lose if you lose money, if you know what the number is, okay? You say, okay, right around this amount, and I'm out. Then what's the fear? I don't get it. And explain to me why you're still afraid. You already know that was the loss. Great. So you step in, you put your money to work, you walk away. If it hits that stop, you're out. Somewhere around that stop price. I'll get to that in a minute. Okay? Stop thinking about it. Stop obsessing about it. Don't keep reliving the same dollar loss that you had. It's already over. That's why stops are so important. It helps me commit capital because I know what the risk is. Now, obviously, here's the caveat put in parentheses. There's always risk. I don't know if the stock is going to gap down below my stop the next day. That's true. That's true. So you have to buy the right position size so you can sleep overnight. But we're talking about risks that we can actually manage. Normal trading in an asset, you took a position, it goes down, you get stopped out. There's no more fear. You know what that is the minute you decide to buy the stock. So that's a principal protection stop. We have 3 stop areas every time we buy a stock. I call it the low of the day that I bought, the low of the move that I'm buying, and the low of the structure that I'm buying. Now, it takes a bit of time to get used to these terms. You'll have to do a lot of work on your own looking at charts. I'm going to walk you through a couple, okay? For those of you who are ARMR insiders, and guys, if you want to subscribe, it's right there. I put it in the description for you right down on YouTube right here. And you can subscribe to the ARMRreport.com, ARMR Report.com. Give me a like if you enjoy this. I'm going to take these little icons off here. Okay. ARMR insiders, you're going to recognize this stock. I want to show you what my stop is on Kirkland Gold, KL. Maybe I shouldn't do this. Now everyone's going to know my stop, but I'll change it up on you. Okay. Here we go. Let's keep this just between us, guys. Window capture. Here we go. There's Kirkland Gold. Now, I'm not going to get into the whys necessarily, but I'll tell you one thing. I like island reversals. So here's a gap down, here's a gap up, and it just so happens that yellow line's a trend line, goes all the way back. This is just basic technical analysis. You can see the stock trades at this trend, touches, blows out, pulls back, finds support right on that trend. That's just basic technical analysis. Nothing fancy there. All right, so we have the gap down, the gap up. This is an island reversal. These are one of my favorite types of reversals to trade. Okay. Oops. All right. So if we're buying the stock in here on this day, which I think that's the day we bought it. So the low of the day we bought it is this particular day. I'm going to blow it up so you can see it more. Okay. This is the low of the day we bought it. Right there. You guys can see that? Okay. So that's the first stop. If it closes below that low, we would exit the position theoretically. That low is $30.45. Okay? The low of the move we're buying is the day before, because obviously that was the gap up day. So we really should have bought it the day before if you want to be nitpicky about it. And we have to be honest with ourselves. Where's the right buy point? It was the day before. So the low of that day is the next stop, 29.72. Okay? And then the low of the move we're buying is this, what is really what's called a pennant. A lot of many different ways to look at this chart. Okay? But you could draw a little pennant. If you guys are technical analysts at all, you'll know what I'm talking about. You know, you draw a little line like this, you know, and draw a little line like that, okay? So you've got the pennant gap up. So below that pennant line, which the low of that day is 24.60, okay? So we've got 24.60 is the ultimate stop. That's the low of the structure that we're buying. The structure is that gap up island reversal pennant. Okay? The low of the move was the day before we bought it. You got to be honest with yourself when you look at it and say, did I catch the break day, the breakout day, the move day, or did I catch really the day after? Okay? Sometimes you buy 3 days late. It's okay, but you have to know what your risk is. Okay, so those, and then of course the lower the day you bought is obvious. Now I will tell you, on a statistically significant amount of my best investments slash trades, hang on guys, hello? No. All right, my best trades never challenge the low of the day I bought them. If you buy right, you start making money right away, you start raising stops, you start trailing stops, you start selling at targets. That's a fact. So that's why the LODB is so important. The minute that gets hit, you start thinking, maybe I'm wrong. You start adjusting your expectations. Okay? So here's the key, wrapping up this thought. I do not exit any of my stops in the morning. Now you might say to me that exposes me to more risk. I would say correct, it does. But through a lot of statistical analysis and a lot of optimization from the years of doing this, I can tell you that getting stopped out in the first couple hours of the morning is detrimental to your trading if you're buying right. So I force myself to wait. And I don't even start to look at stopping out until around 2:30. And I try to last as long as I can later in the day. It kind of depends on the market. I mean, that's when it gets to be, you know, the better you get at this, you get a feel for it, okay? But honestly, most of the time I'm stopping myself out between 3:30 and 4. Because if this is an investment, now this is not for day traders, this is not for even fast swing traders maybe. But the vast majority of you guys, I believe, correct me if I'm wrong, are looking to invest. That's how I'm running most of my money, right? The ARMR Report is about investing. I'm trying to get a position on correctly and hold it as long as I possibly can. I'm not a buy and holder, but some stocks are in my portfolio for a couple of years because they don't violate rules. Those are the ones I want to ride into the sunset. Okay? So for me to stop out in the morning on an investment that should last me multiple weeks, months, and years doesn't make any sense. I have to be disciplined. I have to be willing to suffer a bigger loss because I know statistically over time it plays out in my favor. Okay? And at the end of the day, if I have to, I cut. Excuse me, let's go back and look at KL. This is a perfect example of this situation. KL has twice traded in the morning, even into the afternoon, below the low of the day we bought, which is 30.45. And each day now, for 2 days in a row, it closes above 30.45. Isn't that interesting? Notice how twice the low of the day we bought's been challenged, and it's held twice by the end of the day. So we live to fight another day. Now look, if it gaps down tomorrow, that's the way it went. I can't help that. I don't care about that. I really don't. I have many investments. I put positions on. Position size is key, so no one position ruins your psyche. And you just let it play out. I could be out tomorrow, or this thing could skyrocket higher tomorrow, and we would have stayed in even though the low of the day we bought got hammered in the first part of the day, but by the close, it kept closing higher because that buyer is in there. If you're buying right, you're identifying where institutions are coming in, and you're hoping that they keep supporting the stock. And if they are, then you've got a successful investment. I can't believe I just said hoping. That's the worst thing ever to do in investing, but you know what I meant. Right? There was a guy I knew at William O'Neill for years. I had a great relationship with the institutional sales guy at William O'Neill when I was running hedge funds and whatnot. And he used to tell me, you know, when you're hoping, you should be fearing. And when you're fearing, you should be hoping. And that's usually how investing works. Okay. I want to share with you one more idea here, BIIB. Let's take a look. Okay, this is another stock we just bought. Okay, let's just go over this together one more time. So here's the structure we're buying. You can see another island reversal, and a real beauty of an island reversal. Holy smokes. It doesn't get nicer than this. This is so annoying. Okay, here we go. Right, here's the island. You guys can see that? The island being a structure of trading after a gap down over here and then a gap up. This is a classic island reversal. It's why it's on our whiteboard, and then it made its way into our portfolios. This was a major turnaround, not a turnaround, more of a game-changing event is what happened. Back here, Biogen said that they had a Alzheimer's a drug candidate that failed, so the stock gapped down, and then a few months later they realized that candidate actually worked, and it helped a lot of people, and the stock gapped up. All right, so now you have a new structure in here. So for me, clearly, we can just all do this together, okay? Somewhere in here, maybe you can mess around with it. You don't have to be exact. Everybody has to do a little bit of their own work to figure it out perfectly, and everybody's eye is a little bit different, okay? But probably that's where I would say my structure is. So let's take a look now. We bought the stock yesterday, which was Friday, yeah, okay? So low of the day we bought it really would have been pretty tight, right? That we bought it and it ended up down at the end of the day right near the lows. Okay, so clearly I don't have to explain low of the day we bought it. If it went below that low, we would have been in violation of the first stop. But really, to me, the day before was the move, right? That was the big up move, and then we bought the next day, okay? So the low of the day we bought's here, obviously. The low of the move we bought is here, which happens to also coincide with the 200-day moving average, ladies and gentlemen. One of my favorite places to buy stocks. My second favorite thing, we'll get to this in a minute, is a double bottom at the 200-day. So you can see it broke below the 200-day here, rallied up, broke below and tested again, held it, came back above the 200-day, and that's a trigger for me. Okay? That's one of my triggers. So that's the low of the move we bought, and then the low of the structure we bought is right in here, probably the low of that day right here, which would have been 268.13, I think is the number. Okay? So is that clear, guys? Any questions about our stops on our principal protection? Anything you want to ask me? Go. All right, I'll talk about what the market's doing at the end. Let's move on then. That's the principal protection stop. So now let's just talk real quick about the other stops. The trailed stops are for profit protection. So once the stock goes up enough, I raise my stops to make sure I don't let a gain turn into a loss. How much is enough? It's up to you. To me, on an individual stock, it's between 5 and 10%, depending on how volatile the stock is. If it's a big blue chip, it's 5%. If it's a small cap, it's 10%. These are just ballparks, guys, that I'm shooting out at you. If it's an index, it might be 2.5%, and I raise my stops. Okay? So that's how it kind of goes. 2.5 on an index, 5 on a big cap growth stock like Apple or Microsoft, 10 on a small cap name. Ballpark. Once it hits those targets, I start raising my stops to make sure I don't have a gain turn into a loss. And then I let the stock run. I try to give it as much room as possible, guys, so we can, if you get 1 or 2 names right, they can make your year. And if you cut those gains too short, you're falling into the trap of the average investor who sells his best positions too early and rides his losses down. You have to reverse that. Cut your losses quick, ride your best investments as long as possible. Okay? So when I'm doing profit protection exits, I usually use, like trailed stops, I usually use the 20, the 50, and the 200-day moving average. There's really nothing more exciting than that. I might book profits for whatever reasons at targets on the way up. Maybe when they're 3 standard deviations above the 200-day moving average, I'll book a gain sometimes. But most of the time I try to stay in a position as long as I can, following those moving averages up. And if it's a close at the end of the day below that stop that I've chosen, I'm out. Okay? Last thing about stops. I do not tell people what my stop is. I know I just did that for you guys on KL and Biogen. But what I mean is I don't put the orders in. Now, if you're not sitting there trading all day, it's hard for you to do that because you're going to go to work, you're going to do whatever, and you're saying to me, well, how do I use stops then? Well, if you can, what you want to do is check your positions at 3:30 every day. If it's trading below your stops, you know you have something you have to do. If you can't, then here's what I suggest. You put in a stop into the marketplace at the correct stop of your choosing, the low of the day you bought, or the low of the move, or the low of the structure, and you put it in for half of your position. So while you're at work and while you're away from the desk, if it happens, you've protected yourself. ARMR stands for Algorithmic Risk Management. It's about risk management. So if you can't sit there all day, put in a stop for half to cut your position down immediately if something's going wrong during the day, and then check it at the end of before the market closes to see, did it close above the stop? Okay, I'll hold it. If it closes below the stop, I get out of the other half. There's just a thought for you. Okay, and the last thing, if you can't look all day, let's say you're just working straight through the day, then what you want to do is perhaps split it into 3s. Sell a third below the low of the day, put the order in. Even if it happens in the morning, it happens because you can't sit there all day, it's fine. Put a third in the low of the move and a third in at the low of the structure. That way, if you get shaken out of some and it reverses and runs higher, you still have a position on, but if it craters, you've exited and protected capital. Okay? Okay, let's get to buy triggers. And it's so funny, someone just asked me, I've never heard you talk about Apple. I'm actually going to use Apple as an example for my buy trigger. So thank you for asking me that. And I'll get to Apple a little bit in a minute. But this show right now is about education. I just want to share with you how to stop, what your stops are, so you understand the verbiage when you watch these videos and you hear me talk about things. This is a good video for you to watch to understand what all my stops are. Here are some triggers. I have 2. My favorite trigger is to witness a decline in a stock over a 6 to 12 month period back to a key structure and then buy the double bottom test of the structure. I'm going to show you that in a minute. And at the end of this trigger, I'm going to tell you about triggers, and at the end I'm going to give you a bonus. I'm going to show you a chart pattern from a long time ago, and then we're going to look at a chart pattern from today. And the similarities, I think, are shocking. And it explains why this stock is at the top of my whiteboard and why I'm trying to get in. I don't own it yet. I'm looking to buy it. If you're an ARMR insider, you'll be the first to know. You can join us as an insider. Don't forget, we've just started our own Slack chat rooms, so you can see what we're doing during the day. I let you know what's happening, and I update portfolios at the end of the day. All right, so I'll get to that right at the end. But let's just go over this particular example so you understand what gets me to get excited to actually put capital to work. Let me first say that I don't put capital to work in an aggressive manner unless I think the market has given me a reason, right? So all of our risk on, risk off decisions are driven by our 7 proprietary algorithms on the top 7 indexes that we think drive market risk. The S&P, the Dow, the NASDAQ, and the small cap are the majors. And then you get the momentum, the value, and the IBD 50 as the minors. Those are the 7, what I call magnificent 7 indexes that help us manage risk. So step 1, I get a risk on buy signal with those algorithms on the indexes. Step 2, go find the names on my whiteboard I want to own and see which ones fit these triggers. And those are the stocks that get into the portfolio. It's different than how most people invest. I'm not emotional about it. I don't have any one stock I love more than another. They're all on the whiteboard. I love them all. They're like my children, right? I love all the same. I'm just trying to find the ones with the right setup. I don't care if I miss the other ones. Get rid of your ego. This isn't about did you get this one or did you miss that one. It's about did you make money. That's it. That's it. Did you make money? Did you protect your capital? That's it. The rest is a waste of time and it's for amateurs. This is about opportunity cost of money. You got to find the names you like that you think can have the greatest success. You commit capital, you step away and see if you're right. And you don't beat yourself up if you're wrong. This isn't a sprint, this is a marathon, guys. Let me tell you something. If you beat yourself up every time you're wrong in the stock market, you're going to be black and blue and you won't be able to get up in the morning, okay? Because you're going to be wrong a lot more than you're right. The key is to cut your losses quick and ride your success as long as you can. Now, let's go to an example of buying right. This is a chart of ABV, ABBV. That green box is where we bought ABV last year. For all ARMR insiders, we put it on the list, you all remember. So first of all, you can see ABV had a long decline right to a structure area. This trend line shows you where the support is. Stock came right down to that support. Okay? Once it got there, it touched it once, rallied, touched it a second time. There's your double bottom. Pops up, we're buying the stock right in here. It pops up, pulls back, and we're buying it right in here. Okay, we use an algorithm to tell us when to buy something on a minute-to-minute basis, right, or a day-to-day basis. So once we identify the structure and the idea, and it's on the whiteboard, and we see the double bottom set up, then we allow our algorithms to tell us what day we should buy it. Okay? There's an example. Let's look at another one. Okay, there's AT&T. Forget about that part. We all know that. Forget about the stock market crash. Look at where these stocks traded, right? Okay. Here's the sell-off over a long period of time. Let's see if we can. It actually traded below the structure, right? You would have said to me, gosh, this is where you wanted to get. Somewhere in there is where you wanted to get AT&T. Pulled back right to that spot. Cratered right through it, but set up a really nice chart pattern right below it. Right? It's not always exactly perfect. So it came below it, set up its base. We ended up picking it up right in here at the double bottom for a nice run before the collapse in the market. Okay? And here's the last example. You all know this one. There's Gilead, guys. There's Gilead. Doesn't get easier than that trade. That was maybe one of the easiest trades in my life. Because look at the consolidation. It was so simple down here. We had it on our whiteboard. We knew they were in the midst of a turnaround. We were doing research on it for a while. We were getting ready for it. Then COVID happened, and we got a risk on entry signal on the 27th of January. The stock market has crashed, and we've made money. There's the setup. Okay? Now, you asked me about Apple. And what I want to do with Apple, the second buy trigger that we look for is a classic one. We love cup with handles. If you don't know what that means, you can Google it, look it up. You should definitely read the book, How to Make Money in Stocks by William O'Neill. You can write that down. Go ahead. How to Make Money in Stocks by William O'Neill. It's the Bible. And in there he goes over chapter and verse, cup with handles. So I won't repeat that. But what I will say is, What O'Neill preaches is a cup with a handle, and you buy when you break out of the top side of a handle. And what I like to do, if I may be so bold and in all humility, add to Mr. O'Neill's success, I say, why wait for the breakout if you can buy in the handle? So that's what I look to do. I'll show you what I mean. And we'll just use Apple as an example. Okay, here we go. All right, let's look at Apple right here. All right, this is not a classic example of a cup and handle because it's pretty V-shaped and ridiculous, but it kind of is. You get the downtrend here, okay? There's your cup, comes back up, all right? Then it has this downward move in the handle, real aggressive. Now, O'Neill wants you to buy this thing when it breaks out to new highs, when he sees relative strength growth and all those things. And what I say is, if it's in the downtrend like this, in this case, the 200-day moving average is this black line, one of my favorite spots to buy. So if it breaks down like it did in the handle, and then gives us a buy signal right in here, which it does as it goes back above the 200-day moving average, that's where we want to own it. So when it's running to make new highs and everyone jumps in and it reverses for a couple days, we're not buying out here. We're already making money when it's running and breaking out. And then you can manage the trade however you wish. Okay? And in this case, for me, the stop loss, a trailed stop on Apple is going to be the 200-day moving average. If you're buying the 200-day and it's working, you're using the 200-day as your stop. And you can see it crashed for 3 days, held the 200-day, and then, of course, you know, the rest is history. I mean, the thing went through the roof. Okay? Whoops. All right? It went through the roof. So my point is, there's the cup, the downtrending handle. It breaks out of the downtrend and you buy it. And here's my last thought about this. My last thought is this. I'm always trying to buy as close to my stop as possible. Okay? I want the smallest stop possible. If I wait for a stock to break out, then my stop is way, way down here. That's too much risk. If I'm buying at the bottom of a handle that just turned and I lose money, I'll know that real quick. My stop will be tight. The closer to the stop, the better. In the Slack chat room today, we were talking about KL. It had come right down to the stop, trading right near it. And an insider said, well, should we buy it right here if we don't own it already? And I say, why not? Go ahead. The stop is so close. If you get stopped out, it's tight. If it holds up and the buy was right, and it goes higher from here, you got it better than, than I did, right? Well done. You bought it right near the stop. Okay? So I'm going to wrap up with this bonus thought. You guys know I've been talking about Slack. I just want to share with you a chart. The chart of Slack is so reminiscent. I've been here before, okay? It happened in Facebook. It's almost identical to Facebook's chart. And when you see this, you won't believe it. Check this out. These were both new. Everything's a new issue at one point. So let's go look at Facebook when it was a new issue. Way, way, way back here. Okay. Okay, right back in here, it's a new issue. I'm going to blow it up for you. Okay, now look at this. It came public right in here at like $38, $36. It sold off. It sold off right down to 17 and change. Remember those numbers, guys. 38 to 17, right? Dropped 50%. But let me tell you something. Down in here, let's blow it up again. Let's blow it up a little bit more. Look at this. Okay? Right down in here, everybody told you how Facebook wasn't going to work and advertisers weren't going to pay for it and all the other reasons why nobody thinks it's going to work when it's a huge winner. Okay? Look at that chart. Burn that into your brain, and now take a look at this. Right? I don't have to show you guys what happened to Facebook. We all know, right? Huge winner. Okay? Now take a look at this chart. Don't forget, Facebook went from 38 to 17 before it exploded higher. Now take a look at this chart. That is Slack. WORK. Stock's 40 when it came public. Right around 38, right? 38, 40. Okay? And it comes all the way down to 19. Forget about the stock market crash. Came down to 15 and change because people were panicking. But the real base is right here at 19. The numbers are almost identical. The consolidation pattern almost identical. And now the stock is breaking out above the 200-day moving average. And this is why, one reason why, it's on my whiteboard to own. One of my favorite things to do, talk about buy triggers. I like to find new issues that everybody loves. They come public to fanfare and cheers, and they immediately sell off for 6 months. Then they build a base. Then you get on the conference call and you listen to earnings, and if things are going well, that story that was real when the stock went public is still real. And you're getting it at a 50% discount or somewhere around there. That's one of my favorite triggers. This has been an ARMR education series. I appreciate your time with me. Is there any other questions you guys have before I sign off? My thoughts on Apple. I don't really have any thoughts on investing in Apple per se, although I would say that I have a position on the NASDAQ 100. Okay, that's Apple, that's Microsoft, that's all the big names. I believe Apple and Microsoft are the best places to put money if this market is bottoming right in here. Those types of names. I don't necessarily have an edge that I can share with you, an information edge on Apple, right? I mean, what else am I going to give you there from a fundamental understanding? We all know what's happening with Apple. So we could put it on the algos and we could see where the risk on entry point is. But it's going to basically look like the big indexes. So it's sitting there right at the 200-day moving average. It looks great. It looks probably like a great opportunity somewhere in here. If we get risk on all the indexes, probably this is a good name. It's not on my whiteboard. I prefer Microsoft, but that's true about all my stocks. Let's just take a look here. I just got here. Your thoughts on PSLV? Thank you. I mean, PSLV. I mean, my thoughts. How? I mean, we own PSLV. We own Sprott Physical Gold. We own CEF. I'll tell you my thoughts. All three of them, when we bought them, were trading at a discount to their NAV, and now they're at a premium. I think that there's something strange going on in the physical market. It's priced aggressively. There's a shortage. I think the paper market will start to show that. And I think assets that are backed by the metal that are outside of the banking system, like PSLV, are assets worth looking at. Tesla. How you doing there, Nick? I mean, I like this. I mean, I like the chart, right? It's come right back down to the 200-day moving average, and maybe it's setting up a double bottom. I'll have to take a deeper dive. I've never been a Tesla fan. I don't like the bombacity of Elon Musk, and I have other areas that I go. But I'm not saying you can't make money there. I mean, obviously you can. Okay? All right, guys. Thanks so much for being here tonight. I appreciate it. I look forward to talking to you again on Wednesday. This has been an ARMR Education video. It's part of the ARMR Education series. You can find it on a playlist on our channel. And I wish you all a good night. Take care, guys.